everybody. Thanks for joining me. Appreciate it here on the podcast. Well, the market was fairly flat today for the most part, looking at the Dow and the S&P. But I've got up on the screen the NASDAQ because the NASDAQ was really the story of the day. And you're looking at this NASDAQ down over 1%, about 32 points on the day. And, you know, it starts to jump out at you by looking at this NASDAQ is this, you know, we rolled over here, we rolled up here. This is the 50-day moving average, and it's starting to possibly, is it going to roll over and head on down? Of course, we got the 200-day moving average coming up, and it looks like the NASDAQ may work its way down to that 3,000 level. The reason for this big move today was primarily because of Google. And if you hadn't heard the news, this is the picture of Google here, which is down 8% on the day. It's not as bad as it was, but you can see the volume big time here spike up. Over 12 million shares traded. And what happened was, and I'll pull up a intraday chart. This is a 5-minute picture of what happened with Google. Basically what happened was Google was set to report their earnings after the bell. In the middle of the day, a press release comes out with their earnings. It was very unusual because if you follow earnings, you know that earnings typically are announced before the market opens or after the market closes. And Google's was right in the middle of the day. What tipped people off that this was not intentional was, number one, because it was in the middle of the day, but number two, because the press release had something that said insert basically the CEO's comments, you know, highlighted to where they were going to fill that in with his quote there in the press release, but it didn't. R.R. Donnelley, who was the company that's the publishing company that releases these or publishes these, accidentally published this. But the stock didn't go down because it was accidentally released early. The stock went down because the results were really bad. And so now what you have is Intel results that aren't so hot. You have IBM's results not so hot. And now you have Google's not so hot. And we just came out with Microsoft's after the bell. And Microsoft's still digesting these numbers here. The stock's down just a little bit. And that's been one of the stocks that I've kept for a while that is, I think, just a value stock. I'm not looking at it from quarter to quarter or even day to day. Just looking at it in the big picture. Kind of like Eli Lilly. We had talked about that last time on the podcast. And Eli Lilly was one of those companies that was really, really undervalued. And then it had this big run-up. And I think Microsoft will go through that at some point as well. And it's had some big moves in here. And back in early January, it had this big move. And I actually took profits at that time. Now I'm back in Microsoft. And so, but this is one of those companies that I think is just cheap. It's not sexy. It's not growing extremely fast. But it is cheap. And I think a new CEO or breaking up the company potentially could extract some value. But if Microsoft, you know, if their earnings are weaker and you add them to Google's and Intel's and IBM's, it's no wonder that, you know, the NASDAQ is doing what it's doing, and which is it appears to be at least pulling back a little bit. Meanwhile, you know, there are other areas that are still working. One of those areas is utilities. I did a podcast, I guess, a couple of weeks ago, and we talked about the fact that XLU and utilities were perhaps having this kind of double bottom here, and that's exactly what they did. They bounced off a nice little support area there, and they have turned the corner, and now what you're seeing is utilities have started to go up. As the market has started to pull back a little bit, especially in technology land, we're seeing this big move up in utilities. So utilities look good. You still get this, 4.2% yield, and so utilities are working right now. You still have places like healthcare moving up, financials are moving up. So there's still places to make money. The good old S&P 500 is still working, although it's at this place right now where a lot of people are maybe a little bit concerned because we're seeing this kind of pattern where it could be heading down a little bit. And it's still intact, and it's still working. But I want to go back to Google for just a minute. This picture of Google is primarily one of the reasons why I think you have to be real careful when you're dealing with individual stocks. And there are people on both sides of the ledger here. Some people believe that the only way to really make money in the market is to own individual companies because they have the most upside potential. On the other hand, there's those who stick to ETFs and mutual funds because you don't have to worry about these types of blow-ups like this. And I'm somebody who's maybe use a little more of a hybrid approach where I own a little bit of both. But this just does point to the fact when you have this big downdraft. Remember, everything was humming along pretty well. Google was just strong as it could be, and now it's given back, a month or so of gains in one day. And it just goes back to the fact that you do have to worry about blow-ups, little flash crash incidents, earnings being released at the wrong time of the day, all of these things. And so I do think there's a place for both. And yes, you could potentially make more on individual stocks, but I think owning ETFs, even funds if you're into that, individual stocks, owning a little bit of all these things makes more sense. But I will say what seems to be working right now is there's two things that I think can work. Number one, I think you can look at what's called the mean reversion trade. Those are things that are just stretched too far to the downside. And maybe Google's a mean reversion trade where it will stretch too far to the upside. That means it's going one direction and it's just coming back to its average. Some people use mean reversion in the big picture, like, for example, interest rates. They look at interest rates and say they're too low, and because they're so low that at some point, and I'll zoom out here, at some point they're going to go back up. Where will they go? Well, again, if it's a mean reversion trade, all that simply means is, they're kind of saying, well, this was a high and this was an extreme low, and so maybe we'll get somewhere in the middle here, so I'm going to play for, this thing coming somewhere in this little box here, and that's a mean reversion, just bouncing up there. It's not changing trend necessarily. It's just simply getting back to an unstretched level. And I think there's a lot of people doing that with interest rates where they're simply shorting treasuries, and then they're going long areas like, let's take an example of China. China has been going way, way, way down, and now it's starting to turn the corner, maybe just because it's a mean reversion. In other words, it became so cheap that what happens is people just say, I'm just going to buy it because it's just extended. So there's that particular trade. Then on the other side, there are things like, we talked about energy and financials and healthcare. Those are things that are just working. And so part of what I'm doing is staying with ETFs and trying to stay with what's working. And that could be kind of a rotation strategy where you basically get out of the things that aren't working and stay in the things that are working. And that can complement when you're buying things way, way out of favor. So, for example, owning healthcare or owning financials or energy or the S&P right now has been working. And then maybe balancing that out with buying something that's way out of favor like China. I put this up on the blog the other day, and you probably didn't realize this was happening, but this is Greece. That was potentially a mean reversion trade, right? Because it got so far overdone, it's just bouncing back. But Greece has been a double since the low in June. Who would have thought that? And again, is it based on better fundamentals? Is it based on bailouts? It could be based on anything, but sometimes things go up or they go down simply because they're too stretched like a rubber band. So I think you can make money either way. And I think I would be implementing both of those strategies in addition to owning some stocks that are beaten up. I own a stock right now in my aggressive strategy called ADS. This is a company that basically does white labeling for credit card for businesses in the credit card industry. And so they're kind of behind the scenes. You don't hear a lot about them. But this is a company who came out with very good earnings. Stock was up about 4.5% today, and it's just been moving steadily up. So I want to own that type of company, and you can see the very strong volume here. I want to own that type of company. But do I want to own 50 other companies? Not necessarily, because you do get these blow-ups, and that is a risk. ADS could have come out with bad earnings, and potentially the stock could have gone down. But that didn't happen. But overall right now, I would say the S&P is still, things are still working. And what happened was we got really, really overbought post QE3 announcement. And things were very, very stretched. That was this particular day here. And after that, the market just kind of moved sideways, and it started giving up a little bit. And once it hit the 50-day moving average, I think I did a podcast that day, and we were talking about the fact that it was at a very important inflection point. Even though the 50 hasn't really been a big line in the sand, it's crossed above and below it several times, but it's a psychological moving average that a lot of people look at, the 50-day moving average. And it bounced right off of it. We had about a 3 or 3.5% correction during this time. So it enabled some of these indicators we look at. They kind of worked off this overbought condition where everybody was leaning one direction. It worked it off, and yet the market didn't really fall dramatically. And then, of course, we had the last 3 days, which were pretty good. And today wasn't bad either. It was just Google kind of spoiled the party, and technology doesn't seem to be wanting to participate here. But you did have, semiconductors were down almost 1% today. The NASDAQ was down 1%. But there are still places to make money in this market. So I actually feel pretty good about the market right now, and it can certainly pull back a little more. But things are working, and there are securities that money is flowing into, and you have to kind of stick with those. And that's what's led me to the strategy of wanting to kind of be in the right place at the right time, which is to look at all the ETFs out there and ride the ones that are working, because what I've found is things that have worked in the past continue to work. And so when money's flowing in there, it goes up much higher than we would think. And when money's flowing out, i.e., let's take RIM. When money's flowing out, it keeps flowing out. And this was one of those charts or companies where you could have said, I'll buy here, I'll buy here, I'll buy here, here. These were all value traps. And what's happening now, and especially even on companies like Dell. Dell's a company that has been, not Deltic Timber, Dell has been a company where there's been a lot of value traps along the way. It got stuck in this little box here, and then it fell lower. Then it got stuck in this area, and it fell lower. And so money, when it tends to leave a stock, an industry, a sector, it leaves and it keeps on going. And when it tends to come in, it comes in and money keeps flowing in, just like we're seeing with healthcare. Or like I said, the S&P 500 has been working, and it's continuing to go up. So ride those things until they don't work. However, don't let your guard down and think that the market is in this fabulous place. There's still a lot of issues coming up. Fiscal cliff, obviously, but even before that, we have the election, and we're not in a raging bull market. But we have been in a pretty good market the last 2-3 months here, and we need to embrace it, take advantage of it, and then have exit strategies. And I think using that mean reversion method and using this rotation in these ETFs where you're staying in some of the areas where you see the money flowing into, that's what I've been doing lately, and it's working right now. All right, have a good day. It's a brief podcast, but I just want to touch base and update you on what I'm doing, and also to update you on what happened with Google today. Have a wonderful day, everybody.